Your bank account is stagnant, and high inflation is actively stealing your purchasing power. The old 60-40 portfolio is officially broken, making traditional bonds and cash a losing strategy. As we race toward a financial surge in mid-2026, this is the moment you need to pivot your wealth into commodity equities and hard assets. The only way to not just endure, but profit from this crisis. Here is what we are going to talk about in this video. Why the 60-40 playbook is broken. Inflation double treat. What is the new defensive strategy? 5 core pillars and asset allocations. Lastly, action plan. If you are still holding a 60-40 portfolio, thinking it's going to save you in mid-2026, I have some bad news for you. When I was looking over the latest survey of professional forecasters' data, the old-school investment playbook has been completely turned upside down. Historically, the whole reason you held a mix of 60% stocks and 40% bonds was for balance. When stocks took a hit, bonds were supposed to move up because they almost always moved in opposite directions. But right now, persistent inflation has officially broken that historical inverse relationship, and we are seeing a structural shift where both asset classes are dropping at the exact same time during inflationary shocks. Now, your immediate gut reaction to this might be to say, okay, look, if everything is dropping, I'm just going to cash out, park my money in a high-yield savings account, collect my 5% interest, and wait for the storm to pass. And don't get me wrong, seeing that monthly interest hit your account feels great, but that is exactly where the trap snaps shut. See, with consumer price inflation sharply revising upward to peak right around 6% this quarter, your actual purchasing power is evaporating way faster than those nominal interest gains can accumulate. You are effectively losing ground every single day because the real value of that money is shrinking. Anyway, before we panic, we have to look at what is actually causing this mid-year pivot. What we are experiencing right now is the massive delayed pass-through of global tariffs finally hitting consumer prices at full speed, combined by a fiscal deficit that is blowing past 7% of GDP and sustained energy supply disruptions that keep pushing oil prices around. This combination of factors has effectively raised the inflation permanently compared to the last decade, and that is the exact macro trigger that is forcing us to abandon the old defensive models. We have officially entered a new economic frontier, and to actually survive it, we need a strategy that doesn't just play defense, but actively uses this inflation to its advantage. But to understand the upward pressure this creates, we need to zoom in and break down the deep structural forces at play, specifically the massive shifts in global supply chains and the staggering costs of the energy transition. So, to really understand why your purchasing power is getting hit so hard right now, we have to break down what I like to call the 2026 inflation double threat. Firstly, we've completely moved away from the old era of cheap, efficient global supply chains, and we are now paying a massive premium for localized manufacturing. Secondly, the staggering costs of transitioning the entire global energy grid over to green alternatives, which requires a mind-boggling amount of raw commodities like copper and lithium, which creates a permanent structural upward pressure on the consumer price index. It is essentially like trying to remodel your entire kitchen, but halfway through the project, your contractor looks you in the eye and says that wood now costs 3 times more, and it can only be delivered on a specialized electric scooter that takes 3 weeks to arrive. But it actually gets even crazier when you look at the scale of government spending that is completely overriding everything else. The central banks have been trying their absolute best to cool the economy down by tinkering with interest rates. But it is effectively the equivalent of trying to put out a massive house fire with a tiny squirt gun, while Congress is simultaneously around the back porch dumping premium jet fuel straight onto the flames. When you look at the official data, we are literally tracking a fiscal deficit hitting nearly $2 trillion this year alone, meaning the government is injecting new money right back into the economic system significantly faster than central bank tightening can ever hope to pull it out. We have to look at how we can actually protect our capital, which means we need to shift our focus entirely away from these macro threats and look at the exact specific asset classes that serve as a natural, built-in hedge in this environment. Since the old-school methods of holding cash or long-term government bonds are essentially guaranteed to lose you money under the surface, the game has officially changed to focusing on tangible value and hard assets that actively thrive when consumer prices rise. So let's stop playing defense with a broken playbook, look at where the smart money is moving right now, and dive straight into the specific building blocks of the new defensive portfolio strategy. So where do we actually put our money to keep it safe? You need to shift your mindset toward things you can actually touch, drop on your foot, or physically build with, hard assets and strategic commodities that inherently hold value when the currency is devaluing. When you look at the latest World Bank data for this year, they are projecting overall commodity prices to spike by 16%, with industrial metals hitting all-time highs because the global transition to green energy grids require lots of copper and raw materials. And it's not just metals. Smart money is aggressively piling into agricultural land because, at the end of the day, people always need to eat, no matter what the central banks are doing with interest rates. That brings us straight to the ultimate historical champ of inflation defense, which is gold and silver. Now, I know some of you might be thinking that holding gold is just a speculative play, but when you look at the scale of global sovereign debt concerns right now, the entire narrative changes. Earlier this year, we saw gold tear through all-time records to touch over $5,500 an ounce, and institutional giant J.P. Morgan is literally forecasting it could push as high as $6,300 by the end of the year, because traditional currency stability is starting to fracture under all this government spending. When central banks themselves are panic buying gold at a rate of nearly 200 tons every single quarter, just to diversify away from paper assets, it's a pretty glaring warning sign that you shouldn't ignore. But here is where the strategy takes a forward, because while filling a safe with physical gold, you can't run a high-tech economy in mid-2026 on a pile of heavy bricks or silver coins. We need to bridge the gap between those old-school physical assets and the absolute evolution of defensive growth, which brings us directly to inflation-protected digital infrastructure, like massive AI data centers, cellular towers, and specialized energy grid tech pipelines that own the physical real estate but lease it out to tech giants. It is a defensive play for this environment because you get the security of owning a hard, physical piece of infrastructure. Now that we've established why hard assets are a must, we have to look at the stock market, because you can't just completely abandon equities unless you want to miss out on growth opportunities. You can't just buy the regular broad market index anymore and hope for the best. You need to focus on companies with massive pricing power. It's sectors like healthcare and essential utilities, the non-discretionary stuff that people literally cannot live without. If the price of electricity goes up by 12% or your essential medication suddenly costs more, what are you going to do? Are you going to stop taking your pills? Of course not. You're going to complain. You're going to look at your bank statement, and then you're going to pay the bill anyway. These specific companies can pass their rising costs directly onto the consumer without losing a single customer. Though when I'm talking about utility bills, my own electric bill last month looked like a small mortgage payment because I accidentally left my AC on for 3 days straight while traveling, which was a total financial disaster on my end. And that leads right into the next major rule for mid-2026, which is that you absolutely should focus companies with high free cash flow over speculative tech investments. I know everyone loves the high-growth tech startups that promise to deliver 100 times returns sometime in the next decade. But in a high-rate, high-inflation environment, those future earnings are worth much less today. When capital is expensive, Wall Street stops playing games with promises and starts demanding cash right now. It's like choosing between a friend who promises to pay you $1,000 next year after their new smartphone app takes off, or a friend who hands you a $50 bill every single Friday. Personally, in this specific economic climate, I'm taking the cash in hand every single time. Anyway, once you actually identify these high cash flow companies, it all comes down to the actual weighting in your portfolio to survive the volatility of the coming months. You can't just throw all your money into one or two dividend stocks and assume you're perfectly safe. You need a calculated balance between these defensive equities, the hard assets we mentioned earlier, and a small sliver. It is all about building an absolute fortress around your wealth so you can sleep like a baby at night, regardless of what crazy macro headline drops on the news tomorrow morning. So finally, let's look at the exact percentage and the exact allocations you need to set up for the defensive portfolio. Yield-focused defensive equity, 35%. Hard assets and strategic commodities, 25%. Precious metals, 15%. Inflation-protected digital infrastructure, 15%. Short-term T-bills, 10%. When you take those percentages we just went over and put them together, it creates this beautiful, cohesive, all-weather blueprint that is specifically engineered for the future chaos waiting for us in the second half of 2026. The macro environment right now is completely unpredictable, but this specific allocation doesn't care if we hit a sudden deflationary growth scare or another massive energy supply shock. If oil spikes again and drives shipping costs through the roof, your 25% commodities slice carries the portfolio. If the broader markets panic over rising sovereign debt and suffer a massive liquidity drawdown, your gold and cash allocations act as an anchor to keep your net worth from sinking. It gives you a peace of mind so you don't have to check your brokerage account 20 times a day worrying about volatilities in the market while you're just trying to enjoy your morning coffee. But just setting up the allocation on day one isn't actually enough to save you. You need to understand the secret sauce that makes this entire strategy work. That is called dynamic rebalancing. Now, traditional financial advisors will tell you to just rebalance your portfolio once a year, usually sometime in late December. But in mid-2026, with inflation keeping the markets insanely volatile, waiting 12 whole months to adjust your portfolio is a total financial death sentence. If industrial metals or silver suddenly shoot up 30% in a matter of weeks because of a sudden geopolitical tension, you don't just sit there idle watching the green numbers on your screen. If you implement the 5% drift rule, the second any single asset class grows or shrinks by more than 5% away from its target allocation, you automatically trim the profits from that winning position and put that cash straight back into your underperforming defensive assets. You are literally forcing yourself to systematically sell at the top and buy at a discount, completely removed emotion from the trading. Next, we need to talk about a list of actions. Step number 1. Audit your exposure to high multiple, zero cash flow tech stocks because those are the exact assets that are going to get hit the hardest as rates stay higher for longer. Step number 2. Systematically transition your capital into the 5 core pillars of the defensive portfolio, making sure your hard assets and pricing power equities are fully locked in. And step number 3, set up automated price alerts on your portfolio tracking app at 5% drift threshold so you know when it's time to dynamically rebalance and lock in your gains. If you take these steps today, you aren't just playing defense anymore. You are actively positioning yourself to build generational wealth while everyone else is panicking. Disclaimer: this content is for educational purposes only and is not financial advice. Always consult a qualified professional and conduct your own research before making investment decisions. If you found this video helpful, do me a favor and smash that subscribe button to help out the algorithm. Drop a comment below letting me know which asset class you're buying first, and thank you so much for watching. I'll see you in the next video.